The cash flow index is really at the heart of it. It's a way that we can analyze each debt from a cash flow perspective, which is exactly the way the banks and lending institutions analyze loans.
Right.
They teach us to focus on an interest rate so that they can focus on cash flow. We need to focus on cash flow.
Right. So if you only focus on the interest rate, that may be a fool's errand. That might not be the fastest and best way to get rid of these loans.
Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. Debt, thing that people get pissed off about. Sometimes it's fun to get into, not always fun to get out of, and sometimes it's circumstantial, just crazy things that happen that put people in this situation. So this is judgment-free zone. It's more about how do we create some solutions here. We've got a few questions that came in. I'll turn it over to Chief of Staff Stolba.
Yeah, let's dive in.
Amanda Stolba.
Yes, let's give the people what they're looking for. Okay.
Give the people what they want.
Yes. We're here to answer all of your money questions. So the first one's coming in from Ramina. She says, my question is, how do we pay off our credit card debt? We owe $20,000 in balances. I was thinking of applying for a fixed personal term loan, which we are approved for at 11.9% for 84 months. I'm on Social Security disability of $2,300 a month. My hubby averages $15K adjusted gross income per year. We just can't get out from underneath the credit cards. I want to be in somewhat of a financially secure place in 3 years. I know we can do it. We just need some guidance. So let's give Ramina and her husband some guidance on what to do with their credit card debt.
You said that the reason he's at $15,000 of income per year is some health issues.
Yeah, there was just a series of unfortunate events that happened that kind of put him in a tough spot.
That's the first thing I look at in this situation is how do we increase income, right? If that's at all possible. Is there, side hustles? I did a phone call this morning. You heard me on speaker. They're making money on their vehicle using Turo.com. They're driving it. They're renting it out 3 times a month, and that renting it out on Turo is paying for the car and cash flowing. So you can always look at existing resources to find out how to be resourceful. One of our mutual friends that's been on the podcast a bunch and YouTube with me, Demi, rented out a room on Airbnb. There's millions of stories of Uber and Lyft drivers like that. Like you always got to look at do you have existing resources and things that you can do to be more productive? I started my first car detailing business because my dad had plenty of cleaning supplies in the garage. My mom worked at a credit union. My dad worked at a coal mine, and I cleaned those vehicles. So look at what you have there first. Then we look at the loans. And to me, one of the things that's critically important is called cash flow index, where we take the loan balance, we divide it by the monthly payment. Okay. If this number is 50 or less, we have a cash hog on the hands, right? That means it's a very inefficient loan. If that number is, greater than 100, that's a really efficient loan. It's actually not requiring a very large payment for how much money you've borrowed. So if you're trying to pay something off, you want to know your cash flow index of any loan that you have because it kind of tells us the priority. Now, in their situation, the 11.9% is high, but at the same time, because she's on fixed Social Security amount of income and her husband's not earning as much income, that's why it's a higher interest rate. Now, did they have other assets or anything else?
She didn't go into details on that.
One of the things I always look for is there other assets that are out there? Could you borrow from a 401k? Could you borrow from cash value? Could you go refinance a car? Right? We're looking for anytime you have collateral, like cash value has collateral of life insurance where they'll lend you money based upon how much you have. Usually loan interest rates on 401ks are really low. Now, it's not my favorite place to go borrow money because there's fixed payback periods and it's all pre-tax dollars that you're paying back with after-tax dollars. So there's disadvantages, but if we can lower the interest rate, we can lower the payment, we can improve the cash flow. Those are things to look at. There's also intra-family loans. We've had people that just borrow from family members because they're sitting on plenty of cash. We've done it for down payments for mortgages and things like that because now they're earning more than they were in their measly savings account. But at the same time, there's collateral behind it and they're helping out someone they care about. So I want people to think more resourcefully first. And so 11.9% for 84 months, that's kind of a high payment. Obviously, that's going to be a lot of their income, is going to go to this. So I want to look at those other options.
Now, if she has the option of refinancing a current car loan that her and her husband already have, how would one go about doing that?
Go to your bank or credit union. It's already collateralized, so it's a refinance. Most people don't think about, they think about buying a car and financing it up front. But if it's paid off, you could always go and get a loan. The car is collateral. It's actually a car loan. So
Yeah.
you're going to go talk to wherever you're currently banking at, where you already have an account.
Okay. Now, the other thing I think is really important is understanding the cost of money. Will you go into that a little bit?
Okay, cost of money is simply the highest interest rate that we're paying for our money is the cost of money. So in her case, 11.9%. If that's where all of her loans, that anytime she spends $1, it's costing her 11.9%, right? So it's the highest amount that we're paying on our money. Or it's forfeiting interest that we earn, depending on what that is. So let's say I know I can earn 5% on my money. I know with really high levels of certainty, 5% is pretty easy to do. Anytime I spend $1, I'm forfeiting the right to earn 5% interest. So it's either, we always have an interest cost, right? We either pay interest if we borrow, or we forfeit the right to earn interest. Either way, there's an interest cost. It's just more obvious, the one that we're paying for, than when we forfeit the right to earn. So our cost of money is kind of that bar that says, at this point, I have to earn at least this much to make it worth my time. Like if you have a 5% loan and someone comes and says, I can get you 3% guaranteed, not too exciting because you're losing, right? Because you're paying 5 and you're only earning 3. On the other hand, if you're only paying 3 and you can earn 5, maybe the fastest way to pay off that loan is earn the 5% if it's got predictability, if it's stable, if it's secure. There's a lot of people that erroneously, like remember your college notes, that said, oh, the market's just going to do 12%. Well, if the market was really going to do 12%, the slowest way to pay off a mortgage would be pay the bank extra money. The fastest way would you invest the 12%, and then when it grows, you pay the mortgage off, and you've earned more than you would have saved by paying it down, right? But the reality is the market doesn't get 12%. It doesn't do that long term.
Yeah.
There's a whole bunch of fees and taxes and all sorts of riddled with holes along the way where it goes down. So we have to be really careful. But knowing our cost of money helps us understand whether we should invest or pay off, whether something's efficient or inefficient, effective or ineffective. So I always think about my cost of money before I do something because there's always an interest cost.
And that's where the cash flow index comes in, is understanding your cost of money.
So knowing your cost of money, it's personal finance has to be personal. For some people, paying off a loan is so critical for them because it brings peace of mind. They feel, oh, I'm finally free. For other people, like I have a mortgage on my home. I don't have car loans. I don't have a mortgage on my cabin, but I have it on my home because I don't plan on staying there forever. It's really low interest. And in a highly predictable way, I can out earn it. And I could pay the home off tomorrow if I want to pull it out of my cash values. Now, other people, they just don't feel comfortable with that. They're going to lose sleep. No savings is worth that, right? So maybe you're just best paying that off, and now you can be more productive. One is the economics, which is your cost of money. The other is your peace of mind, which is just what your personal preference is. And I think we need to take both things into consideration, where some financial gurus just automatically go, pay off your debt or else you're enslaved. The Bible says pay off your debt or else you're enslaved, but most people haven't even identified what debt is. Debt's when you owe more to someone than you have in an asset. When you have an asset worth more than what you owe, that's actually equity. It's the opposite. So my home is worth more than the loan on it. I'm not in debt. I'm in equity, but I do have a mortgage. Now that's probably blowing a few people's mind. A few people are pissed off right now and they want to tell me, paying off my mortgage is the best thing I've ever done in my life. I'm not.
Some people get very passionate about that.
If you paid it off, congratulations.
Yes.
I never told you not to. I have no dog in the fight. I don't care. It's just know your options and do what's best for you.
And the peace of mind is a really important factor. I think sometimes gets left out of the equation. It's just like if you scrimp and you save and you kind of cut back, like eventually you'll get there and be able to enjoy your life and you'll be able to show up. But I think peace of mind allows us, like if we consider that in part of this situation and in our lives, it allows us to show up differently in the world. And when we show up with more confidence, because we have peace of mind, then we can create greater value. We can be more creative with our thoughts. We're more open to connecting to other people, which expands our means. So peace of mind is actually, I think, a really important part of deciding what to do with our money.
It's an essential piece.
Yes. Okay, so we're going to move on to a question coming in from Richard. Okay. So you've discussed a couple of ways that Romina could pay off her loans. Richard has a specific question. He said, should I follow Dave Ramsey's plan or use a different strategy for paying off my debt faster? I've been doing some research on trying to pay off my debt. I love the idea of the snowball effect where I pay off the lowest bill first and use the extra income to pay towards the next biggest loan. Do you have any suggestions or comments? I'll let you
That's a
speak, and
good
then I have a
plan.
couple of follow-up questions.
You know, that's a good plan. What I like to do is a combination of what's called the cash flow index that we just showed, loan balance divided by monthly payment, and you only attack one loan at a time, pay the minimum to everything else, and it's the one with the lowest. The lowest cash flow index is what you're going to pay the extra to. Now, the difference between that and debt snowball is this takes a little bit of consideration into the interest rate.
Yeah.
Right? I mean,
Not just the
I
payment.
like the philosophy of let's just pay off the one that's the easiest to pay off, the fastest to pay off, because then that's freed up and we got more cash flow. Love that. But this is just going to be an equation that says, well, let's figure out which one's going to be the bigger movement.
Which one
when
should
it
I tackle
frees up,
first?
right?
Yep.
And then in order to really improve it, the 3 R's are restructure, reallocate, and renegotiate. So to restructure a loan, we're looking at, well, what if you refinance your home and pull other loans into it that have higher interest rates and now you got lower interest rate? What if you know, what we said earlier, refinance your car and pay off higher interest rate loan? So if you can restructure or refinance loans, you might be able to get better cash flow indexes and therefore pay less in interest. Then the second thing is reallocate. Let's say that you just have an underperforming asset. You have something that's not earning a high interest rate, but you're paying more than what it's earning. Let's cash that thing out, pay off that loan, and then that's going to free up that cash flow. That's going to get you a guaranteed return because you've saved the interest. Or renegotiate. Like if you have a credit card, don't just assume whatever they're charging you is what you have to pay. Call and renegotiate. Ask questions like, hey, what are your best deals? Are there balance transfer deals? If I'm looking to cancel, what can you do for me to keep me as a customer? These types of questions, so you get to the retention department and they lower those interest rates. Or a streamline refinance with your home where you stay with the same company but get a lower interest rate because you have options because interest rates are low. You just have to make sure you have a good credit score, decent collateral, which is cars and homes are decent collateral, right? The right cash flow reporting, so you look good to the bank.
Yeah.
And then good connections, so you're going to the right institutions that specifically deal with what you're looking for. So I would say go with the cash flow index, pay only extra to one loan at a time. But as you do that, look to restructure, look to reallocate, and look to renegotiate the interest rate so that you can actually get ahead even faster.
Okay. So is there ever a time when the snowball method is a good fit for reducing debt?
Sure. It's not a bad method at all. Yeah.
Just always
Helped out a lot of
consider
people.
the cash flow index,
Yeah.
the interest rate.
I'm just giving a little bit different take on it. And here's my big concern. If you're trying to eliminate debt, don't get in a scarcity mindset that's all about reduction and sacrifice and scrimping and saving. Look to keep more of what you make, get more efficient. Look to expand your means. Like you said, how can you add more value? How can you increase your income so you have more to work with?
Yeah. Amen to that. I remember when I was using the snowball method myself to pay off my Plymouth Neon back in college. and just even after I graduated, my Plymouth Neon, it was purple, just riding in style.
Is Plymouth in business these days? I haven't heard that word for a while as a car company.
I mean, I don't know. I don't keep up on cars.
Oh, okay, yeah.
But maybe it was a Dodge. Who knows? But anyway.
I think it was a Dodge Neon.
Okay. So I was paying off this little car of mine, but I remember spending hours every month.
That's the concern.
Like budgeting. And I would erase
Did you love
and
it?
I would move money around.
Did you feel
and
inspired?
I would I would fill my envelopes and it was not inspiring. I wasn't thinking about how to expand my means. It was just me trying to get by.
You've got to start with production first.
Yes.
And reduction second.
Yeah.
Be mindful with your cash. Frugal's fine, but as soon as that starts to turn into miserly, as soon as that starts to consume your thinking, as soon as that starts to be, you miss out on life and you don't invest in yourself and you don't think about impacting others or value creation, that's where it becomes detrimental.
And it was actually really stressful for me, So
I'm just stressful for you. That's what you traded off. You don't have to worry about your debt, but you got to stress about my crap.
Yeah. So I think it's a good starting point. Like you said, Richard, maybe just incorporate some of these other things. And, if I think of investments, if I would have spent the 2 hours a month investing in myself, investing in ways to expand my mind and, grow in deeper ways, I probably would have been more fruitful. So I know that's preaching in the choir. You talk about that all the time, but
you
I experienced that So I can relate to Richard, and I think it's a great question.
There's like 4 different systems out there that people are using to tackle their debt.
Yeah.
And some of them work.
Don't pay it and go bankrupt.
Yeah, you can go or you can just do it haphazardly. Yeah, so don't pay it. I guess that's the 5th one.
Yeah.
Just don't pay it and go bankrupt.
Get massive student loans and they don't get a job, and then just default. But they'll still come after you.
Those all are not good strategies.
No.
So anyway, I mean, some people they have a haphazard approach to everything in their life. They're money avoiders, and so, they pay their bills and they don't have a system. And so like you say, it's a shotgun approach. They don't really know where they're funneling their money. But there's really 3 systems out there that I've been, aware of that people are using very successfully at paying off debt, and each of them has their merits.
Okay.
One of them is called the debt avalanche, which is a system where you focus on the loan with the highest interest rate,
Okay.
and you line up all your loans from highest to lowest interest rates, and you target the one with the highest interest rate.
Yep.
The second one is called the debt
Not
snowball.
my favorite. Okay, debt snowball.
I don't love that one either.
Yeah.
The debt snowball is one that was developed by a gentleman out in Tennessee, and
Davey Ramsey?
Mr. Ramsey. And
He's good for the train wrecks. If you're a train wreck, he's got good advice. Now,
Right.
this diversified investment portfolio is going to disappoint you, but his whole path to get out of debt by living off rice and beans, if you're a train wreck, he's really good.
it works because he focused on the psychology of the person, and so he'll line up all your
Smart
loans
dude.
from smallest to biggest. And he'll pay off the smallest one, and as soon as you pay that off, momentum and snowball until all the debts are paid off.
Cool.
Now he goes a little bit extreme in the event that all debt is evil, all debt's bad. You want
Put
to
your credit card in a freezer and block of ice and, blah,
live
blah,
off
blah.
rice and beans while you do that.
I did notice his website took credit cards back in the day, though.
Did it really?
I don't know if it still does.
I don't think it does anymore, but
Very important, pertinent information for you guys.
that's right.
Just trying to poke other people that teach finance. I don't know.
That's right. So I was intrigued with the psychology of his system. Paying off debt, based on the lowest to smallest, highest balance. And
Remember, we worked with Jessica Marsh, and she used to follow his system, but
Right.
lived pretty miserly and miserable because it was all about like every dollar had to have a name.
Scrimping and scraping
scrimping
and-
and scraping and living in a house they didn't want and driving cars they didn't want.
Right.
I'm just gonna say that we're kind of badasses, and then we took Jessica. We saved her $2,500 a month with what we're about to teach you. Then we saved another $2,500 a month saving tax. And then we had them buy this dream house that was on a big farm that I went and visited. They had chickens, bees, a horse, and then built up their practices. And now she gets to take a 3-year sabbatical when her husband.
Oh, I didn't know he was going on a sabbatical.
Yeah,
Wow.
I took her to a Metallica concert recently in Birmingham.
Oh my gosh, good for her.
I went to speak and then went to a Metallica concert.
It's good to hear that this
That's
system.
what I do. You got hair like this, you got to go to a Metallica show. That's how it works.
Right. This can be a game changer, honestly. And about 8, 9, 10 years ago, I was going through a period of time where I was, kind of struggling a little bit because I had, accumulated a little bit of real
Didn't
estate
know me enough.
loans.
Didn't
Didn't
me
really
well
know
enough.
Garrett.
Didn't listen to my advice when I was like, don't invest with that one dude, you're going to lose it all.
I did lose it all, unfortunately.
I hate to say I told you so, but
Right.
you could have been eating jam that whole
it was
time.
before I met you, Garrett, so I mean, what do you do?
Yeah.
So anyway, I developed this system called the cash flow index, which is a system that allows you to determine the most effective, most efficient way to pay off your loans.
Yeah.
And what we do is we'll take a look at each of your loan balances, and there's a simple formula that we use. You take the balance of your loan, and you're going to divide it by the minimum monthly payment.
Yep.
Not annual
Loan
payment,
balance,
but monthly.
minimum monthly payment.
Correct.
Spits out a number.
Spits out a number.
The smaller the number, the worse at effectiveness and efficiency of the loan.
Correct, yes.
The bigger the number, the better.
Think basketball. If
Basketball,
you're scoring
not
50
golf.
points,
Right.
that's right. You score 50 points in the NBA, and you're going to lose that game for sure
Yeah.
every time.
Yeah.
So the smaller the number, the worse. And we usually say that if you have an index less than 50, that you're in the danger zone, which means you got to pay off that debt now. It's your hair's on fire. My hair's been on fire a lot, as you can see.
Your head's a lot older than you are.
It probably is.
That's what I figured out.
That's right.
Your head's like 80.
The rest
And
of
you're
me is
like 40
40,
something.
yeah.
Yeah.
I'm 45,
Yeah.
so.
Yeah.
Yeah. So anyway, we put all your loans in this system, and you spit out that number, and then what we'll do is we'll line up all your loans and liabilities based on that cash flow index. And then instead of using a
Okay, the
shotgun
minimum to
approach,
every loan but one.
but the one that has the lowest index.
Yeah.
Well, let's say
So
that
ignore the interest rate and focus on the cash flow index. The cash flow index will take into consideration the interest rate, but not as the sole piece. And someone is
Right.
going to go through this, and you're going to find out your lowest cash flow index is a 0% interest rate loan. And you're going to be like, why would I pay off a 0% interest rate loan? Because we're looking at the bigger picture here. We're considering debt to income. We're considering cash flow. We're considering like freedom and safety. It's not just one aspect.
It's not. So an example, and we worked with a gentleman quite a while back, 5-6 years ago. His name was Jordan Cooper. He's actually, great guy. Dentist out in Arkansas, if I remember right. And he came into our office and he was in a cash crunch like I haven't seen before. The guy had
He was expanding quite a bit,
growing the business like crazy. And what I did is I did a kind of a detailed analysis of all of his loans, and we found out that there was like 10 of them that had an index below that threshold of 50, and we're like, we got to get rid of this quickly. And so we had a quick triage. We talked about a couple different options. We ended up taking out a larger loan, business loan, at a much lower interest rate. So a lot of his interest rates on his loans were 8-10%. We consolidated all that debt into a single loan. The complexity of his life went out. The interest rate on that loan was about 5.25%. And he freed up $17,000 per month, not per year, but per month in cash flow. I mean, can you imagine what kind of difference that would have in your life?
What a gangster this guy is, huh? That's a gangster move, $17,000 a month.
He was happy with us.
Yeah, I mean, but here's the thing. When he says debt consolidation, he's not going to a debt consolidation service and harming his credit or doing something like that. He's simply restructuring his loans. Could you use a car loan that's a more efficient loan than a credit card? Could you use and refinance that? Could you refinance a home and pay off a business loan? There's like different ways that you can restructure these loans to improve your cash flow index. You're not just stuck with the cash flow index that you have.
Exactly. So we just simply restructured some of his loans, and he was able, he had told me beforehand that he had a really, really hard time saving money for the future. He just couldn't do it. He couldn't even live wealthy today.
That, huh?
Oh my gosh, yeah. I think he was redirecting $10,000 a month into his wealth capture account. He also, he loved to spend, so I think he was spending quite a bit of money on enjoying himself,
he also
living
really
wealthy.
Nice gifts. He gave me a nice big old paleo basket. I attempt to eat paleo, it's just that there's non-paleo food that tastes really good.
I love it.
But I buy paleo stuff and then just sneak a little ice cream in here and there.
Exactly.
Non-paleo.
Love it.
Sorry, Rob Wolf.
So anyway, this is a system that we've used successfully with thousands upon thousands of people here at Wealth Factory. And I don't know what the number looks like. About 7 or 8 years ago when I was running the numbers, it was like we had helped people pay off over $20 million worth of debt. And we'd help them free up, on average, about $2,700 per month.
That's just you, man. We got other coaches.
That was like
that's just you, right?
6 years ago.
Yeah.
Yeah.
I mean, like, it's probably in the hundreds of millions of dollars.
I guarantee it.
Because we got Tim, we've got Reeves, we've got Wade, we got a crew doing this kind of stuff for you. So use this cash flow index, pay the institutions less money, keep more, shave off the time that it takes to pay these things off. It'll boost your credit score, your confidence in your wealth capture account.
Absolutely.
And you don't have to be on Miracle Whip. You can have jam.
I thank you, Garrett.
Yeah?
This is really nice.
I just, I'm so generous. Look at that. It's like, it was a big deal.
This is more than I've had yet in my lifetime.
All right, cash flow index, loan balance divided by minimum monthly payment, categorize all of them. Only pay extra to the one with the lowest cash flow index. If it's a really high cash flow index, you might not even pay anything extra to it in the future because you might go, well, I'm going to sell my house in the future anyway, and I've got enough money earning an interest stashed away. It really comes down to personal preference and your own peace of mind. Let's talk about this cash flow index and how it works.
Okay, so the cash flow index is really at the heart of it. It's a way that we can analyze each debt from a cash flow perspective, which is exactly the way the banks and lending institutions analyze loans.
Right.
They teach us to focus on an interest rate so that they can focus on cash flow. We need to focus on cash flow.
Right. So if you only focus on the interest rate, that may be a fool's errand. That might not be the fastest and best way to get rid of these loans. So if you have more than one loan, what you want to do is write down these loans individually. What's the loan balance? And then you want to divide it by the minimum monthly payment. Not what you're currently paying, but the minimum monthly payment with each loan individually. So loan balance divided by minimum monthly payment, that's going to spit out your cash flow index. Now, if that index is less than 50, I call that the cash hog.
Yep.
You have a cash hog on your hands. It means a high payment in relationship to a relatively low balance. Great situation for the bank and financial institution because they're getting a lot of cash flow without a lot of their capital at risk, right? But if it's above 100, that's a more efficient loan, meaning, okay, you have a decent amount of money that you've borrowed with a relatively small payment in relationship to that. Now, somewhere between 50 and 100, I'd call that the danger zone, or the, maybe where we look at is there a structure that you could go through to improve your cash flow index? But let's just go through this and why it's so simple and the methodology of how to use it.
Yeah, I mean, the simplicity of it is just that simple formula that you gave them. It's so easy to quickly identify which loans are cash efficient for us and which loans are cash efficient for the bank. Once we identify that, now we have complete control over those payments, and we can prioritize which ones to pay off, prioritize the payments that we're going to make. I see what I call it the flock shoot of debt repayment, right? Where people say, well, I've got all these loans and I'm going to pay an extra this much to each loan, and they feel like they're making a lot of progress.
I call that the shotgun approach.
Yep.
Right? You're just like, you shoot and all of it goes there. It's like, okay, whichever loan was due earliest is what okay, I paid extra because that extra money, then the next one you pay extra to. It's a slower, more risky process. Like, what we're really teaching in Win Then Play is economic independence. Economic independence is creating enough recurring revenue, which is known as cash flow, to cover life's basic expenses. So sometimes it's hard to create that cash flow, and some of the easier things to do would be to lower the expenses, but not through budgeting and cutting back and elimination, simply through efficiency, through what you could do with the cash flow index to eliminate an expense, not because you cut back and enjoyed life less, but because you deliberately and intentionally attacked it in a way that helps you to lower that bar. Right? When it comes to standards, we want to raise the bar. When it comes to economic independence, we want to lower the bar so it's easier to get over or to jump over. I don't jump very high, so that kind of helps me out, right?
Perfect.
All right, so let's say you've got 5 loans, and one of those loans is a 30. The other loans are in the 50s, 60s, or over 100. So tell them what to do.
So you're going to focus all of your efforts towards loan repayment towards that cash flow index that's a 30. Now, the other thing about it, too, is depending on the balance or the size of that loan, it comes back into control of the money. So if it's $100,000 that I owe, and I can only afford to put $1,000 a month extra towards that loan, it's going to take me quite a few years to pay that off. So I don't necessarily want to make that $1,000 a month payment to them every single month, right? I'd rather put the $1,000 a month in my own account, earn money on that, use it for growth, and then let that grow till I have a big enough balance to pay the bank off.
Just be careful. You're not going to go put that in the stock market or mutual funds or some speculative investment like cryptocurrency. We want something that's stable. We want something that's fairly liquid, meaning it's available to you. You could access that, and that it's not going to be volatile, that because of the economy, all of a sudden you're like, oh, I thought I was doing better, but now I'm not, and it's going to take me longer to pay off this loan. So you'll want to just continue to be a listener to figure this out as we continue to unveil different opportunities, but we want to begin with the cash flow index. You only pay extra to the one with the lowest, but if you find out that that's still going to be years before you pay it off, you want to set up a separate account and start funding that account first, because you want to build up enough in there to be able to write a check to pay this off in one fell swoop while you still have access to cash, liquidity, and a chance to earn interest. So we'll have other podcasts on how you can lower your interest rates, or how you can restructure your loans, or how you might be able to reallocate if you have inefficient or underperforming assets. But right now, we just want to focus on the cash flow index. And look, you might even find that if you have a lot of loans and you're feeling what most people would call deeply in debt, that can be a hindrance for your health, for your sleep, and for productive thinking. So I even have a strategy around that, because we want to help you abolish scarcity. It's the greatest destroyer of wealth. And one of the ways you could do it is what I would call the 90-day debt delay, where you find your cash flow indexes. And if you have one that's a really low cash flow index, rather than immediately putting money towards that low cash flow index, for the next 90 days, where could you invest your money as a business owner to increase productivity and profitability? As an employee, you increase your skill set or increase your ability that would allow you to get a raise and maybe even learn what to ask and what to do in those interviews in order to increase that income, so that you're investing back into yourself so that you become more productive. And then after that 90 days, now you can regroup with an increased income to start attacking those loans. It reminds me of when I was flying out of Newark. So I was flying out of Newark, and the pilot got in and said, we're in number 27 for takeoff. I was like, we're going to be here for a long time. Then they opened another runway. that was actually going east, and I was trying to go back to Salt Lake City. But once they got in the air, they just turned around. So we actually went in the wrong direction for 10 minutes. And then we turned around and started heading the right direction. But it was better than sitting on the ground waiting forever. So the 90-day debt delay could feel that way. You're like, well, I'm not actually paying down my debt right now, or not paying down my loans, to be more accurate. Well, the reality is, yeah, but you're now increasing your production. You're becoming more abundant. You're being able to create more value. You're increasing your income, which can make a massive difference over time, rather than falling prey and victim to being in scarcity and only scrimping, sacrificing, saving, delaying, deferring, paying this down, and not having any ability to think more productively.
Absolutely, and I love the cash flow index because it gives us an opportunity to discover what our best opportunity is for our cash, right?
Right.
We can look at that cash flow index and say, well, how much cash flow am I freeing up if I go after all my loans? But if instead I use that money, as you just described, to grow, will that outgrow the money that would have been saved by paying off those loans?
Right. You're going to hear a lot from us. Invest in yourself. First, always, right? So you're doing that now and in the future. You're going to hear us say you want to build up plenty of safety and liquidity, because it's not just so that you can handle turmoil or turbulent times, but it's so that you have cash for the opportunities that come your way. There's going to be opportunities, whether that's to buy a business, whether that's to make the right investment, whether that's to, grow your money, not because of, hey, everyone's doing it, but because something within your expertise, something within your wheelhouse, something within your knowledge. We're all in store for dozens of opportunities over our lifetime. Most people just don't have the cash to capitalize on it. And the best time to be able to capitalize on it is when no one else has access to cash, because it's all tied up in the equity of their home. It's all tied up in paying down one loan that didn't lower a payment. So we're trying to help you get more control over your money, have the proper methodology, have a lot more efficient method, and use and determine with this cash flow index. Now, what I've seen happen sometimes is the one with the lowest cash flow index is a 0% interest rate loan, either a credit card or a car loan. And so people will kind of battle with me or say, well, that doesn't make sense. I would pay off a 0% interest rate when I have a 12% credit card over here.
Absolutely. And the only time it would make sense is if those balances are similar, right? Or the cash flow index on them are similar.
Right.
Then I can understand, like, okay, well, one's
It's
a
a few
20
points away.
and the other one's a 22.
Right.
Fine, go after the one with the interest rate. But when there's a big difference, you're going to get so much cash freed up for so little capital invested.
That you can now go attack that next loan with more vigor, with more cash.
Absolutely.
And you've lowered your risk because you no longer have that payment. And we're looking at everything from debt to income. Debt to income is for every dollar you earn, what percentage of that dollar has to go towards your loans, right? And the higher that amount, the harder it is to get access to borrowing, or maybe even better interest rates, because you can't go borrow the money because you've used too much of your debt to income. So if we can lower the bar from economic independence because we pay something off, and then attack the next loan with even more cash that has been freed up, and plus, if we lower your debt to income, you might have access to better loans, and maybe paying off some of these loans actually improves your credit score. An improved credit score might lead to getting better interest rates. We're looking at a much bigger picture here, not just isolated in one single vacuum.
Absolutely, and that's what happens a lot of times with the loan thing, right? It's just get out of debt, get out of debt, get out of debt at all cost, any and all cost.
Right.
And so they just attack those loans with full vigor. They jeopardize their safety and security. They jeopardize their growth and production and all those things. The cash flow index allows you to get back into control. Yeah. And say, nope, this is the best way for me to handle it. I'm only handling this one. I'm going to do a debt delay. We have all these options that allow that growth and abundance, which will far, far outgrow the benefits of just total loan elimination.
Right. So loan balance divided by minimum monthly payment. Find your lowest cash flow index. After you find your lowest cash flow index, look, how long is it going to take to pay that off? If it's within 12 months, you might just put money directly towards that to pay that down. If it's going to be years and it's going to take longer, you might want to set up a separate account and start saving your money. We'll be able to reference different opportunities and options as we go through a tool called cash flow banking, and a strategy that way where you could store your money and get maybe 4 or 5% in a tax advantaged way, rather than sitting at 1, maybe 2% in a taxable way in most savings or money market accounts. And to even get 2%, you got to put in a decent amount of money or have access to the right types of banks for that. So we're looking at what are the most efficient ways. You might delay paying any loans for 90 days. Invest back into yourself, in skill set, back into your business if you own a business. or even creating a side hustle where you can start using those dollars to invest in building out the processes, procedures, or the types of things that allow you to earn that extra income. And then when your income goes up, then reallocating towards attacking a loan and paying it down, or reallocating towards putting more money into that savings account or that investment account that's more safe and stable, that then when that grows to a certain amount, you could pay these loans off. So look at those cash flow indexes, understand where you're at, and even if it's a lower interest rate, you might attack something with the lower cash flow index because it's going to free up that cash flow faster to attack the next loan. You might improve your credit score, which means there's going to be more opportunity. We're looking at the big picture, and I'll kind of end with this. I was in Minneapolis. I remember this because I just left Cancun, where it was 82 degrees. We're talking Fahrenheit. Then I flew into Minneapolis, where before wind chill, it was negative 22 degrees. The only conversations we had there were about the weather. Every time I saw someone, they were typically calling someone to come start their car. I met people that they did this for a living because it was so cold. You had to have special tools just to get the car to turn over. And my beard was frozen when I walked outside because I had some like oil in it to kind of shape it. I was like, wow, this is insane. And then now I'm speaking to 400 people. And before I've even really said anything, this woman's raising her hand, which made me think, maybe my fly was down. What was going on? I wasn't sure. But she was pretty emphatic about it. And so I was like, okay, I finally called on her. And she's like, I'm a CPA. And we joined working with your team, 13 and a half months ago. And your team said we'd be able to pay off our loans with a third less time. And that's not the case. Now, I started to consider when she said this, maybe I need to go outside, even though it's negative 22. That's where I really remember the weather. She says, in reality, we only have 18 and a half months left. Now, what did they do? They looked at the cash flow index. They found out which loans to attack one at a time. They then used other funds that were underperforming to pay off higher interest rate loans, which created a guaranteed return and improved their cash flow. They refinanced some of their loans and consolidated them at a lower interest rate, which then allowed a better situation that way, right? So with all of this, it shaved off a lot more than we originally anticipated, and then they took that extra money to pay down these loans that was going towards the other loans.
Okay, we're going to get into Scott's question here before we get ourselves into trouble. Okay, Scott's question. He says, I'm interested to know when, during these times, you would recommend low cash flow index debt be paid down. With everything going on, I'm now holding cash.
Let's pause. Explain cash flow index real quick for those that
Well, so there's a lot of different systems, and this is a really great point of paying off debt. And now may or may not be the right time to do that, but there's the avalanche system, the avalanche method that we hear from Susie Orman, which is basically you've got to pay down the loans that have the highest interest rate first. There's the Dave Ramsey approach, which is forget about the interest rate. Let's just focus on paying off the loan with the smallest balance and then have psychological wins and just pay off the rest in order from smallest to largest. The cash flow index is completely unique and different than anything that has been designed out there, because what we'll do is we'll actually analyze the loan itself and we'll look at the balance of the loan and what is the monthly minimum payment. Not what you're actually paying toward the loan, but what's the monthly minimum.
What's required.
What's required to be paid, right. And so it's
sometimes
a simple
people
formula.
pay more and they're above the minimum, or they're doing biweekly payments or something.
Correct, yeah. So when we're calculating this, just take that out, any extra payment you're making. So you'll take the balance of the loan and you'll divide it by the monthly minimum payment, and that'll kick out a number. And that number will be anywhere between 0 and 300 typically. A score under 50 is typically what we'd call a danger zone debt. And so with those type of loans, we want to just pay off as quickly as possible. Now the question is now the right time to do that? So let's kind of finish up what he's asking here.
Okay. Yeah, I know that's a question that a lot of people have, because as people are not working as much, income is down, they have debt, but then they don't have that peace of mind, and they're looking to do something to create a situation that feels more secure for them. So it's like, I got to get rid of the debt because it's bringing me stress, but then I also need the cash flow to live on. And so I think this is a common situation. Yeah, it feels very it just feels like a challenge.
You almost
situation.
like salsa dance to that question. I felt like right there.
Feel the rhythm, feel the ride. Okay. So next part to that, with everything going on, I'm now holding cash more closely, including loaning everything out of my cash value life policy. In parentheses, he says, the bank seems fine as the Fed isn't missing a beat, but life insurance companies use banks too. And I'd hate for mine to get squeezed. And I did work for a mutual life insurance company in the early 90s that went bankrupt. So maxing out all of my personal and company lines of credit is something that he's doing. 3 of 5 income streams have gone to zero. So I no longer feel like 3 months of reserve is enough, and 6 months seem too little as well right now. I believe the 3 streams might come back in July or August, so right around the time that we're filming this. I'll bet not to level it, good heavens, I'm stumbling over my words today. Let me start that sentence over. I believe the 3 streams might come back in July or August, not to the level it was, but I might lose another and the largest income stream by the end of the year. So I'll continue building up a bigger wealth opportunity cash fund, but what besides enough money to pay off debt should I plan as my trigger to start paying down the low cash flow index debt? There's a lot there. Did you pick it up in my stumbling of the words, Dale?
I did, yes,
Okay.
I did. So, and Garrett, I'd love to hear your feedback on this too, but my first thought on this is that the cash flow index, in my opinion, is the most efficient way to pay off debt, but that doesn't mean that you should always follow it. There's actually a system, and I actually call it the 90-day debt delay, and Garrett talks about that as well. And I think this COVID-19, crisis right now that we're going through, warrants that. And maybe it's a 120-day or 150-day debt delay, where instead of putting that extra money toward paying down the loans, stockpiling cash, building that up for liquidity. Because here's the deal. If you put extra money towards your car, you pay extra money towards your house, if you try to aggressively pay down those student loans, you're locking that money up in equity jail. That money is no longer accessible to be borrowed against or to take out. And if this continues, you lose your job. This could be a bad crisis for you. So it's really important to build up liquidity. And I know there's some other financial pundits that disagree, that say that you should just pay everything down, even now. And I disagree on that.
You might put yourself in a worse situation if you're paying off a loan, and all of a sudden you have that loan go down in balance, and then the bank takes that available balance away. If it's like a credit card or a home equity line of credit. What Dale's saying is when it's amortized, it already automatically takes it away because you pay it down, you can't get the money back out with refinancing. And if you're in a cash crunch, it's really hard to refinance. Banks love to lend money to people who don't need it. When you really need it, they don't want to lend it to you. So my methodology here would be the 3 R's. One is look to restructure your loans. With interest rates as low as they are, now's a good time to restructure because maybe you can lengthen the loans to have a lower payment. That doesn't mean that you have to wait longer to pay off the loan. That's the misnomer that people kind of fall victim to. It means that you have more control of your cash flow, and when you have all the money to pay it off, you can just pay it off in one fell swoop. So restructuring loans and lengthening them, or even restructuring them where you're pulling other loans that have higher payments into loans that make it a lower payment, like a mortgage or something like that in times of crisis like right now. The second is renegotiation. If you're going from a non-collateralized loan to a collateralized loan, like a car or a home, you can get a much lower interest rate than a credit card, unless it's maybe an introductory rate with the credit card. So that could be really helpful. And the third one is what we want to be careful of, and I think it's really direct to Scott's question, is reallocation. Reallocation is if you have an underperforming asset and you're like, well, if I cash that in, I could pay off a higher interest rate loan and free up cash flow. The problem is with his income being uncertain and some of it being shut down and cut off, getting access to cash and capital is smart. And he's talking about tapping into his lines of credit. I think it's a good idea. Now, some people are going to cringe when I say that because they just think number one rule is stay out of debt. But the number one rule is to create more cash flow. The next thing is to create more profitability. The next thing is to make sure that you're finding new ways to create that cash flow. And we're in a major opportunity coming our way. So if you don't have access to capital, you're going to miss out on those opportunities. So if you pay interest to access that capital, look at it as like an insurance policy. Whatever interest you're paying is insurance to have access to that cash. Is it worth to pay that insurance premium or that loan interest in order to get access to that capital? In times like now, I would say absolutely, certainly yes, unless you're absolutely destructive with money. He's an investor. He's got several investments. I don't see that being the situation with Scott. Other people, as soon as the dollar shows up, $1.15 is spent. Don't ever get access to cash. Get rid of every credit card. Never borrow money. Rent instead of buy. If you're not going to be responsible for your finances and you mistreat money, it's going to mistreat you. Yeah. And, unlike bad relationships that might stick around, money just goes out the door. Yeah. It doesn't, It's not partial. It doesn't, hold on for hope for a better future. It just says I'm gone. So these are the things we have to pay attention to. So I think that's quite a bit of information for Scott, really, and hopefully some good, insights. Go ahead.
And here's one tip that I'd share as well. And I've heard you talk about this before, Garrett, as well. But Scott, if you have a fully paid off car, one thing you could do is go to the bank and take out a cash out and refinance the car, because right now interest rates on vehicles are 2.5%, 3%, maybe 1.5%. I mean, they're ultra low right now. If you have higher interest loans, this is a great way of, lowering the payment and lowering the interest rate as well. So just another thought, food for thought.
Yeah, that's a good suggestion. I'm curious to know, like when you talked, Garrett, about, if you're not good with money and it comes your way and then you spend more than what you have, how can someone then begin to assess, like, how do I reshape my money personality, the associations that I have with money coming in or going out? Do you guys have any thoughts on, just from your own life experience, how you've worked through your money, your relationship with money, and how it's grown and changed over the years, and how you've overcome like little hiccups that, maybe at one point in your life kept you stuck or not as liquid?
Well, I used to be a miser. And I think Garrett and I can both agree. When I was growing up, I lived off peanut butter and Miracle Whip sandwiches because that's what was in the fridge and that's what I ate. And I kind of carried that into adulthood, and that just, that personality just, permeated everything that I did. When I would buy Christmas gifts for my kids, I would literally go to Deseret Industries, which is a local Goodwill, place here, and just buy, spend a couple dollars on their Christmas presents, because who needs really nice Christmas presents is my thought process. And so that, it wasn't until I met Garrett and started realizing that I was really caught up in that scarcity mentality, that miserly mentality, that I, realized that I needed to shift. And so that's kind of been a transformation. It doesn't happen overnight. But I had the opposite problem of, having no debt, but, not spending any money on myself.
So I could talk about this for several days. As you know, we're going on a little play around this topic, but most people are trapped in a losing game. And that losing game happens when they put money above all else. And a lot of times they see money as power. And the more money I have, or the more things I can buy, the better I am, the more other people will like me, or the more I could show off. I mean, or the safer I'm going to be. Like, there's these different games. So the first shadow persona of money is the miser that Dell talked about, which is playing a game called preservation. It's scrimping, saving, sacrificing, delaying, and deferring, so that one day, someday, they'll have funds they never spend, right? It's just, what can I do to save? What can I do to eliminate? Then you've got the conservative, which is, they're a little bit more of an investor, where they're going to put money into retirement plans, but they're going to try to save the highest percentage of their retirement fund, or into their retirement funds, through delayed gratification, delayed happiness. And they're kind of condescending. They think they know everything. Dave Ramsey's the perfect example of that. Then the third thing is we have strivers. These are the people that hustle and they try to scale, and they'll work harder at all costs. And they play a game called status, which is like, hey, do you like me now? Look at all the stuff I have. And then there's the high roller, which is the last money persona, which plays the game called opportunity. They win big, but they lose big. There's a lot of kind of body bags after they're gone, of people that have lost their life savings, and there was these high promises. So those are the shadow personas of our money personality. And if we're stuck in the consumer condition, looking to take more from the world than we give to it, if we think that someone owes us something, if we think that profit is evidence of deception, if we think that fear, doubt, and worry is going to help us out with our finances, or we don't want to pay attention to our finances, prosperity is only a game of responsibility. And what it takes is a hard look and say, why am I spending? Am I spending because I don't feel lovable? Am I spending because, I want something because I feel I deserve it because I've worked so hard, but even though the money's not there, I'm going to do it anyway? Like, I grew up in a coal mining town where people had to sell their truck, but they kept their boat because I worked so hard in the coal mine, I deserve that boat. And so those types of notions are about outward spending versus inward reflection, or investing in ourselves to get clear about how can we produce more value? How do we deliver more to others? How do we solve problems? How do we serve others? And then we can flip to this place of vision, value creation, and discover our hidden capital. Our hidden capital is our mental and relationship capital. And when we invest in our mental capital, we have ideas, knowledge, and skills that can serve other people, and actually dollars follow that value that we create. But we have to heal from this losing game of trying to impress others with our money and trying to buy ourselves happiness instead of like finding happiness within. And so it's a big question still, but as you know, we've got a few videos on it. We got a book coming out on it. So I just think that when we can stop thinking like we're unlovable, unworthy, or any of those uns, and we can just embrace like a life that we love based upon us creating a game worth winning. Creating a game where we serve others and we solve problems, and it's consistent with who we are and what we want to achieve in the world, not at the expense of another, but by complementing another, it's a completely different world. So look, that's a great final question to turn your thoughts into profits and to build the life you love. If you go to wealthfactory.com/megakit, we've got a cash flow guide that you can download, plus my book, Killing Sacred Cows, which helps you identify scarcity in your life and instead embrace more abundance, and even another book. So there's 2 books and a guide. It's on me. Just give me your email so we can stay in touch and we'll add value to your life. Want to continue the path to be a better investor? Make sure that you're not losing money and taking too much risk? Well, click here and learn about strengths vesting.